The net profit margin is a key profitability matrix for a company. It represents what percentage of sale has turned into profit. Simply put, the higher the net profit margin, the better. Here is a comparison for the net profit margin for Kasman. For 2020, the net profit margin was negative 231%. This indicates a net loss, meaning expenses exceed revenue, which is a serious concern for any businesses. For 2021, the net profit margin improved to negative 98%, but the company was still operating at a loss. While the loss decreased compared to 2020, it is still a significant negative margin. For 2022, the net profit margin further improved to negative 42%. Although still negative, the company appears to reduce its losses year over year. Lastly, a sudden significant increase and decrease in net profit margin might signal aggressive accounting practice or revenue recognition manipulations in Kasman. Quick ratio, also known as the acid test ratio, is a measure of a company's ability to meet its short-term obligation using its most liquid asset. Here is a summary of quick ratio result from Kasman. In 2020, the quick ratio was 0.08 over 1. This suggests that the company had excess in liquid asset for every ringgit of current liabilities. In 2021, the quick ratio decreased to 0.049 over 1. This indicates a reduction in the company's short-term liquidity, as it had just under 5 cents in liquid asset for every ringgit of current liabilities. In 2022, the quick ratio slightly increased to 0.053 over 1, showing a small improvement in the company's short-term liquidity compared to 2021, but still lower than the 2020 level. Overall, these changes in the quick ratio could be a cause for a concern. The consistent low quick ratio below 1 over 1 might indicate potential difficulties in meeting short-term obligations. However, it is important to consider other factors such as industry norm, the company operating cycle, or any recent significant event like mergers, acquisition, or the impact of a global pandemic that could affect the company liquidity positions. The interest coverage ratio is a financial ratio that measures a company's ability to meet its interest payment on outstanding debt. Here is the comparison. For 2020, the ICR was negative 21.18, which indicates that the company was not generating enough earnings to cover its interest expenses, leading to a negative ratio. For 2021, the ICR improved to negative 14.17, but still negative. This suggests that while the company's earnings increased or its interest expenses decreased compared to 2020, it was still not enough to cover the interest payment. For 2022, the ICR further improved to negative 2.16. Although still negative, the company appears to be moving closer to a positive ratio, indicating an improvement ability to cover its interest payment. Overall, this negative interest coverage ratio over multiple years could indicate a potential risk for the company, as it might struggle to meet its interest obligation. However, the improving trend is a positive sign. It's crucial for the company to continue improving its earning or reduce its interest expenses to achieve a positive interest coverage ratio.
Now I will explain about the ratio analysis of Hasbullah company. So for the first ratio is net profit margin. For Hasbullah company for 2020, Hasbullah got 83%, and for 2021, 79%, and the last one is 2022, Hasbullah got 86%. As we can see here, the net profit margin for Hasbullah company is increasing from 2020 to 2022. By this increasing, the company can improve its profitability and generate more cash flow, which can be used to reinvest in the business, pay dividends to shareholders, or reduce debt. However, it is important to note that the increasing of the net profit margin should not be done at the expense of long-term growth or customer satisfaction. So next, we're going to take a look at the quick ratio for Hasbullah company. So for 2020, we got 1.427. So for 2021, we got 1.622. And the last one, 2022, 1.593. By increasing the quick ratio from 2020 until 2022, Hasbullah can improve its short-term liquidity position and reduce the risk of defaulting on its current obligation. A high quick ratio indicates that the company has sufficient liquid assets to cover its current liabilities, which can build trust and lead to favorable credit terms. However, it is important to note that increasing the quick ratio should not be done at the expense of long-term growth or profitability. For the last ratio that we're going to analyze for Hasbullah company is interest coverage ratio. So for 2020, we got 18,927.6. For 2021, we got 5,692.86. And for 2022, we got 5,486.68. we can conclude that Hapsang company interest coverage ratio is decreasing. It may be a sign that the company is taking too much debt or that its profitability is declining. In such cases, the company may need to take steps to reduce its debt load, improve its profitability, or both. This could include measures such as cutting costs, increasing revenues, or renegotiating debt terms with lenders.
Potential indication of fraudulent. Net profit margin. Negative net profit margin over multiple years could indicate underlying issues in the company operation, cost structure, or business model. The second one is quick ratio. Change in the ratio that happen quickly and for no apparent reason could cause concern. Financial ratios should generally be steady and predictable. Abrupt change without good justification could be cause for concern. The last one is interest coverage ratio. This negative interest coverage ratio over multiple years could indicate a potential risk for the company, as it might struggle to meet its interest obligation.
Moving on to the evaluation of operating segmental for operation and related party disclosure for two selected companies within our group. To begin with, when it comes to initial and subsequent measurement, MFRS 8 is not applicable. Regarding disclosure, both companies adhere to MFRS requirement by providing general information about operating segments, type of product, and services. Additionally, they disclose information related to geographical segments, encompassing revenue from external customer and the value of non-current asset. In the case of Kissan Berhad, it goes a step further by furnishing details about its reliance on major customers. This is due to the fact that revenue from transaction with a single external customer constitute 10% or more the entity revenues, prompting disclosure of this significant information.
Next, I'm going to explain about MFRS 1-to-1 foreign operation of Hassan Company and Kissan Company. The initial and subsequent measurement of Hassan Company, the company does not comply with the requirement of MFRS 1-to-1, where it is required the company to record a foreign currency transaction on initial recognition in the functional currency. The disclosure was stated by Hassan Company are comply with the MFRS 1-to-1, where is the amount of exchange differences are recognized in profit or loss. Hassan was disclosed that the foreign exchange exposure in transactional currency other than functional currency of the group entities are kept to acceptable level. This is comply with MFRS 1-to-1 when the presentation of currency is different from the functional currency. That fact shall be stated, together with disclosure of the functional currency and the reason for using a different presentation currency. It is stated in Notes 25C in the financial statement. Meanwhile, for initial measurement of the Kissan Company are comply with MFRS 1-to-1. All of transactions in foreign currency in the company are measured and recorded in the functional currency. The company has been record the transaction into Ringgit Malaysia, which is functional currency of the company, which stated in Notes 10 and 29C in financial statement. Next, the subsequent measurement. This standard requires the use of closing rate for translating monetary item in the statement of financial position, and for non-monetary item are measured at fair value. The foreign exchange on trade receivable of the company are translated at the closing rate at the date of statement of financial position. Meanwhile, the non-monetary item like impairment loss are translated using the exchange rate. Subsequent measurement of Kissan was complied with the requirement of MFRS 1-to-1. For disclosure, the company complied with the requirement of the MFRS, where the exchange difference from subsequent translation are recognized in profit or loss. All of exchange differences relating to that foreign activity are recognized in other comprehensive income and accumulated in the separate component of equity are reclassified to profit or loss as part of the gain or loss on foreign exchange. This stated in the Notes 26 of financial statement.
Next, I'm going to explain about related party disclosure, Hapsang and Kissan. For initial measurement and subsequent measurement, it is not applicable. In terms of disclosure, Hapsang and Kissan provide the following details. Details on the transaction, such as the buying or selling of real estate and other assets, as well as the providing or receiving of service. Next, they provide the entity of the parent company as well as the ultimate controlling entity. They then go on to reveal the details of the deal, including the obligations and any remaining balance. Not to mention, the business has disclosed the salaries given to staff members.